Okay, so there's negative gearing, neutral gearing, and positive gearing. Negative gearing is essentially a strategy where you're saying, I'm intentionally wanting to lose money every single month on the hope that I'm just going to get capital growth. So negative gearing is essentially, let's look at all the expenses. It's where the cash flow is less than all the expenses to maintain that property. This is what Australians do commonly way too much, and this is the number one reason why most Australians get stuck on two properties, or 90% of investors get stuck on two properties because they do negative gearing. Whereas positive gearing is where you're making more from the rent than what it costs to service and look after that property. That's called positive gearing. But in Australia, it's not very commonly known that you can get positively geared properties. People just don't think it's possible when it is, because that's primarily what we focus on. The difference between negative gearing is a strategy to say, I want to intentionally lose money so I can get tax deductions. Whereas positive gearing, or let's just say negative cash flow, is very different from negative gearing. Negative cash flow is where it's just right now, it's not making much money, but the overall intention is for it to go into a positive cash flow position. That's the difference between the two.